All right. Good morning, everybody. GIF, huh? We made it. What we've been waiting for all week. We're going to get data today. Markets mostly green in anticipation. The numbers for the data are not widely disputed. So unless we get some shock and awe that we're not expecting, should be just a continuation into the higher highs that we've all been talking about forever. Japan up 0.5%. Small caps at a quarter. NASDAQ, S&P, Dow, less than a half, but they're all green, just toeing the line. Hong Kong trying to do its own initiative, basically flat. It's all in the first part of the day, PCE. And if you look at the numbers, that's where I was saying there's not a lot of discrepancy or anticipated change from where we've been, where we're at. So we're just going to keep on keeping on. Even the tariff talk has really fallen back when it comes to how much impact there is. We all joke about the whole taco thing, but the markets are getting to the point where they're not even really paying attention to new headlines on tariffs. And that seems to be working for the administration. It's what they want. But just remember, for a while, their announced plan was to sow chaos and keep everybody guessing and promote that chaos into the market. So, when it was bad in March, April, they were doing it on purpose. The markets don't like unknowns and they don't like chaos. So after April 7 or April 9, when the administration capitulated and backed away because of the bond vigilantes, everything just kind of calmed down. But at any time, they can ramp that right back up again and sow chaos into the market. So just keep that in mind. It's just like having the plunge protection team on the payroll, all right? To be able to play save a hoe whenever the market dips too low. This is going in the other direction. It's throttling the market, holding it back like a governor. It'll be too late in the day, but we're going to get some stress test results. You guys see finance moving around pretty well yesterday. It was getting a lot of flow. They're just positioning in front of this. So, it's going to be after the market closes. We're likely just going to see the results into next week. But yeah, we're going to get some bank stress data. It's very likely that, nothing is going to come out of that surprises anybody. That headline's worth keeping your eye on through the day today. I'd circle back to that one when you have a little bit of time. It just came in at 30 minutes ago or so. So the news was attributing this push yesterday to the White House's conversation and announcements on the big, beautiful bill and getting it through the Senate. Really keep that front and center in your mind for when is it going to slow down or stop. Now, granted, the bobbing heads on TV will often attach whatever narrative they want for why price is doing what it's doing. And sometimes, they're very far off the mark, and sometimes they're not. Either way, we had a really solid push through the week, gotten us into these levels. And it's just based on warm, fuzzy feelings, right? It's all sentiment driven. Nothing has changed. We don't have the bill. Yeah. So, feelings can change and attitudes can change, and this can all just flip really fast. It does. It is worth mentioning all the way back in April when we were working our way back up out of this low, and everybody kept saying, oh, it's a bear market. This is just a bounce in a bear market. Then we were into, early part of May, and it's, well, we're still in a bear market. It's just a very strong bounce in a bear market. Then we got, into mid-May, and you know what I'm going here, right? It's labels don't help, just forward positioning. So at the end of the day, we can call this thing whatever we want. We still just need a way to trade it. I don't think we can call it a bear market anymore by any stretch of the imagination. No matter how many bricks we have in the wall of worry, we are continuing to grind higher. The forward PE on the indexes is above the historical average. The unemployment still not hitting critical levels. Every metric that we would use to define how the market is really doing is all pointing to the upside. So, get the talking heads out of the equation and just look at what price is doing. Overnight in the volume where you had 56,000, it's on par for the week. And we've been seeing 50s most of the week. Tuesday we had a little extra. But we're seeing this consistency with a lower overnight volume. It's not too bad, really. The call wall 6250, that rolled up. We'd been waiting on that call wall to get rolled, and ta-da, there it is. At the same time, they rolled the put wall down even more. All things considered, the put wall being rolled up is a bullish action, right? We would perceive that as a bullish threat. I don't know if threat's the right word, but you get the idea, right? Posture. There you go. But it's counteracted by having the put wall rolled down, which is a bearish posture. If they had rolled the put wall up with the call wall up, that would have been like a double bullish posture. But one, to me, cancels out the other. I was looking back in Spot Gamma because you can chart those two on the platform at how many times we'd seen the put wall drop with the call wall rising and having, a continuation to the upside. It's happened, certainly, because these are not making price move, right? They're just like guardrails holding price back. So with that in mind, the put wall being rolled down just gave us room to fall. Less structure if we start to fall that might hold us back. And on the other side of that equation, with the call wall rolled up, they just removed some overhead resistance and moved it farther away. So just because the call wall is not going to be restrictive closer to us, it doesn't mean that we're going to go to the call wall. We're still well above zero gamma in the volatility trigger. This puts us in a positive gamma environment. If we run with that logic in mind, the dealers will sell into strength. So if we break out, they'll be selling into that breakout. And if we break down, they'll be buying into that breakdown. That is how they have to maneuver to remain delta neutral. We're above all the major moving averages, so no threat there. And at the moment, the worst case scenario to any of this is how far we are from the mean. We're getting a little bit too far away. We have a market maker move this morning. Another indication that the thing we've been waiting for all week is here. They are hedging this morning, additional hedging, because they always hedge. This is additional hedging on top of the hedging that they already carry. They're worried about something and they're spending money to protect themselves in the very short term, just for today. So we want to continue to keep track of the market maker move to see if they are going to increase how much hedging they have, and if it goes away after the PCE this morning. Because we're making an assumption that it's a PCE. It's a pretty fair assumption, right? All things considered. But trust but verify, right? So while we think it's the market maker move on the PCE, if by say 9 a.m. or even 9:30 and that thing hasn't begun to decrease, then the PCE wasn't the reason for the market maker move. We are closer to the upper ADR. Base case scenario is that we hit it, but we're not up by much anyways, right? Just a little more than 1/4%. Still, since we are closer to the upper edge, that would be the base case argument. The problem with that argument is that we have economic data this morning. So, price with these two lines don't care about anything else. But the economic data doesn't worry about pivot points. So let's get through the data at 8:30 and reevaluate where we are afterwards. It's very likely that we're going to get a liquidity gap this morning, right? It's a really big bar at 8:30. And from that gap, we'll determine where we're going to go next. Today's floor pivot is higher than yesterday's. That's bullish. Price opened above it, and that's also bullish. It's a wide channel. A wide channel implies that if we break out, it doesn't stick. But we already have broke out, and so far it is sticking. So we're keeping the breakout at this point. We are at the R1. If we were looking for an R1 S2, then this would be as much upside as we get, and we would begin to focus on this missed daily pivot down here. A missed daily pivot, an MDP. It won't count for today. If we go all day without hitting it, we would actually count it on Monday, because at any point today we could hit it, and so we wouldn't know that it's a missed daily pivot until we make it to the end of the day. So if we reject R1 here, break the Globex low, get inside the channel, get through the floor pivot, S1 is the first target, which lines up basically with the RTH low of yesterday. Get through that, then we can target the real low of yesterday and the S2, R1 to S2, 6120. To get there, you've got a number of pivot points, 6211 COG, 6200 options level, 6192 COG, 6150, 6132. There's a lot of things to hit on the way down, right? We really didn't see the value area tighten up as much as I would have liked. I was expecting to see this come up, the bottom side of this come up, right? This line maybe brought up into this zone here, that 61.32 area, and that would give us a tighter value area. Didn't get it at this point. It doesn't really matter, but it's just a wide value area. We're certainly above the 61.50, which is the central point of this week's volume. While we do have a double distribution, is in no way balanced. And if 61.50 fails, we'll likely drop through this shallow area really quick, and we could see 6,000 without much trouble. I know that sounds crazy when we're sitting at 6,200, but it is what it is, right? 61.50 has all the strength, all the structure to it. And if we lose that pillar, then there's nothing holding us up to get down to this previous level today, right? There's always the potential for things to go wrong. So if we begin to unwind really quick, swing for the fences. A 6,000 strike put, 0-day on the ES. Of course, you could, jump over and use something like the S&P, and that would target 5,800. Sounds crazy, right? But we're talking about if bad things happen, things go wrong today, and nobody's expecting that. There's no reason for, any idea that things will go bad. We've got one economic data point, and that's it. Get through that, and it's just going to be a slow roll into the end of the day. $10-day, 30-minute volume profile with TPO. 61.50 is very likely where the point of control is going to go when it does move, as we've discussed earlier this week. But we still have to wipe out more candles from down below here before it gets moved up. As always, there's two ways that this point of control can get moved. One is that we stay in one spot and we build out a lot of volume really significantly in that one spot. Or over time, we lose the candles that built the current point of control's location, and by default, it gets moved up on its own to another level. It's very likely that that's what we're going to get because we've been continuing to move. We haven't left much footprints behind. So there's really no other place for it to go except to one of these previous spots where we've held the line and built out some structure. We do have a disagreement between the TPO and the volume profile at the moment. I don't see any reason for the point of control to drop down and match that TPO. So it's likely going to be the other way around. TPO will come up first, and then we'll see both of them come into this 61.42 area, 47, whatever that is. We are above it. That's going to be the main thing, is that we're not going to end up underneath it when it gets moved. We got a new VPOC yesterday. $61.92 cog line. Imagine that. Those cog lines just keep coming into play over and over again. So today, if we do begin to break down, 61.92 should be on your radar. It should have been anyways because it's a cog line, but whatever. We don't really have much of a disagreement between the TPO and the volume profile this morning. It does get really shallow underneath this current pivot. You see there's not much here. So if we break this pivot around 62, 407-ish. We can drop down to the previous area, 6,200, build it out. And if we lose that, then the VPOC, probably the halfback of the RTH would be next, then the RTH low, Globex low. Some nice structure around 6170 area. Yeah. Because it's Friday, we have next week's expected move on the table. Now, this is a projection at this point. It's not set in stone, and it won't set in stone until after 4 o'clock tonight, right? The market's got to close, and the numbers have to quit moving, and then it'll lock, like all of these previous weekly ranges have been locked into place. Once it's locked, it won't move again, and that'll be our range. But on Friday mornings, it does give us a bit of a foreshadowing or a projection of what it could look like. One of the things I like to do is look at the current week's range and compare it to next week's range and see what's the projections for next week. Now, these weekly ranges are built on 2 pieces of data: how many days, and then implied volatility. So the worst that can happen is we have a short week. That way the days don't match. But we don't have a short week next week. So we had 5 days this week. We have 5 days next week. That's the same. The only other number that changed is how much volatility was priced into the market this week versus how much is expected to be priced into the market next week. The higher the volatility, the wider the range. So we can see with this little box that I drew, and I didn't line it up perfectly, right? I just kind of eyeballed it between the current week and set it on the next week. The range projected for next week is narrower than the week that we had this week. Now, at first blush, that sounds good, right? Less volatility. The market must not be as concerned next week as it is this week. But there's a little flaw to that, and it is economic data will often shunt or suppress volatility into that economic event. Think of it like this. Things like FOMC can be volatility suppressing. And the first time I heard someone say that, I thought, you must be broken in the head. You've never seen the way we move on FOMC days? I mean, that's the very definition of volatility. That does not look like it's suppressing jack. But that wasn't what the comment said, right? FOMC is a volatility suppressing event because as we get closer and closer to FOMC, the markets start to go sideways. Volatility is another word for movement. If we're not moving, we have a very low volatility. We go sideways in front of big events like FOMC because the market doesn't want to commit money to something until they know what the new data is going to be. Now, with that in mind, when we see a narrower range projected for the next week, it tells us that the market is looking to go sideways or looking to move less next week while it waits on something. That's the takeaway, the short and the sweet of it. It doesn't mean that we're going to go sideways. Doesn't mean that we're going to wait on anything. We've had FOMC weeks, for an example, where we just pop on Monday and run. FOMC be damned, and it just goes. So it's just being priced in. It's not making price do anything. So next week, it looks like the market has expectations that something big is coming, and it wants the information. Next week's not the holiday week, is it? Snuck up on us. I guess next week is a short week, right? We're off for the 4th. So there you go. I guess, man, that came fast. narrower week, not as many days because it's a holiday, that would attribute for the narrower week. And as long as you don't blow your fingers off with fireworks, you should be back the following week. I don't know why anybody would want to go long here just based on general principle. We've run for 4 days straight, right? Like what? After the 5th day, everybody else decides to jump on? Huh. Boy, okay. We're more than 1.5% above the 10-day. So this is not extreme. We're not outstretched, but we are outside of the zone. Got that 1% zone that we generally focus on. So we don't have to worry about mean reversion, least squared methods, anything like that. And for the 10-week, we're almost at 5%. Now, we've been to this level before. It's not to say that, this is something new, but we are starting to get into that level on the 10-week where we have to be concerned that we've gone a bit too far. So you can see that we've been higher than this. Even back here, we were higher than this. We can get above 5% when we think about how far away from the 10-week we are. But this is too much. So, when I look at this, every time I look at it, I'm asking the question, have we gone too far, too fast? Whether it's to the downside, the upside, I don't really care. It's just asking that question. And there's a really good example, right? When we went 10% below the 10-week, that we mean reverted really fast and we whipped back the other direction. It was just too far. Well, we're getting into that level now where we've just gone too far. It doesn't mean that we're going to go backwards, that we're going to fall down now because we've run too far. That's not what I'm saying. But when you weigh the odds of what's more likely, that we go up another 1%, 1.5%, 2% from here, or that we go down from here, the odds say that we would go down from here and or hold the line, because that's all we have to do for the 10-week to come back to us is just sit still. It'll move to us one day at a time, closer and closer. We need a correction at this point because we're a bit outstretched, but that correction can come through time or price. So we are a little outstretched. We could get a little bit of a blow off top or a last hurrah before the rug pull, or we could just sit sideways over the next 4 days in a short week and do nothing, right? We don't have to go down. $0.10 is a nice lotto. I was pricing in some 6,700 short calls on the ES, and I was using the end of August. I don't think it was these. I was using my other broker, Tasty Trade. It might have been these August ones. It doesn't matter. Well, it would help if I'm on the right market. I was getting some really good prices on those calls. And I went ahead and picked up the 42s and the 47s short puts. Look at the price of these puts. I mean, they're still offering some good money out here. Okay. To sell a naked put in the ES, you need like 16,000. And if you're thinking, gosh, that's a lot. Yeah, try to sell a naked put on the SPX. So this one put way out in the middle of nowhere is $200. You know, it's like, do you really think we're going to go to 4,200 in the next 63 days? Yeah, no, me neither. So you need, 16,000-ish to sell a put here naked. That's way cheaper than you need to sell a put on SPY, SPX, right? Those margins, or the margin requirements to sell naked puts on those two, just off the chart expensive. You want to sell options in the indexes, do it in the ES. Don't do it on the NASDAQ. That thing is the worst. The NQ, completely illiquid. The options are horrible. If you're day trading the options on the NQ, that'd be one thing, right? Or even just for the end of the week, that's fine. But don't get trapped in the NQ, and the margin on the naked NQ options gets jacked up really fast. So looking at what's up and what's down this morning, Bitcoin down. The Mag 7 down volume is down. I know that it's got a lot of like a double negative in there, but we have the FANG up volume and FANG down volume. So the FANG down volume is down. It's basically bullish for the FANGs. And we've got precious metals down. Well, at least the miners are down. Looking at what's up, NASDAQ volatility. It's like the VIX for the NASDAQ. Uranium, the Mag 7 up volume by 2% this morning. UFOs up, robots, quantum. It's going to be one of those kind of days. Uranium, chips, Mag 7. We're even getting small caps rocking it this morning. We could get a little bit of a short covering rally today. That would be a nice way to just finish off this wild week. The options that I was using was the last one for August. This broker shows the options a little differently, or the expirations, but it was this one, 63 days. I wanted as close to the September series because you got to think about the expiration of the contract, right? I don't want into the September series contracts. And on my broker, they weren't highlighted yet. So I was using the last week of August, 63 days out. Check the liquidity in this one, though, 49 days out. It's a little closer in, but it has more liquidity. And, you got to go with the crowd if you can. Probably get better prices. I just keep running that question by, right? When there's nothing else to trade, when I'm not seeing anything I like, or we're too close to FOMC or some other event where I don't want to go out and get into the rest of the market, I bring up something like the ES and just start laying out some levels. Do you really think, for an example, that we were going to go to 5,800 by the end of July? Just start with a basic question like that. You think we're going to go to 5,800 by the end of July? If the answer is no, Sell a put under 5,800. It really is as easy as that. If you want more money, sell a put closer to the money. So, okay, 58, fine. You think we can go to 59? Because if you really think we're going to hold above 59, then you might as well just sell a put around 59. You'll get more money for it. What about the big round number 6,000? You really think we're going to go below 6,000 between now and the end of July? And if the answer is no, sell a put around 6,000. It's a really simple process, right? To just look at the level and ask, you really think we're going to go that far in this period of time? And just keep in mind that the multiplier is the option, the tick value of the product you're trading, the ES. So if you're seeing $8.50, it's not $8.50, right? That's not how much credit you're getting. So just for an example, let's just roll up here. This says it's 117.50, right? If I hit confirm and send, that 117.50 is actually $5,875. How did they get that? They took 117.50 and multiplied it by the tick of the ES. So, you know, if you're trading the NQ, its tick happens to be different. Same with oil, crude, copper, whatever it is that you're trading. Options on futures are multiplied by the tick value, not by the simple 100 that if it was Apple or something, right? Look at Apple, you look at its option and it says $4. We would just multiply that by 100 because it's an option, right? It's what we do. But it's not that way in the futures. So be mindful of that. 24% of the S&P is up 0.5% this morning. I got to say that's a lower number than I expected. With all of the sectors that are up this morning and the sectors that are up specifically, right? Not just how many sectors we have, but which ones we have. I expected a better number than this. So that's not as bullish as it seems. Looking at the NASDAQ and how many names are up at least 0.5%, only 31. And again, that's not as much as we would have expected. At least I was expecting more than that. Having said that, though, the names that are up matter, right? And we can see all these chip names that are up this morning, at least 0.5%. And you got some junk, Coca-Cola's in there. Let's see, we got Shopify and PayPal. Oh, there was a couple of retail ones that were moving around quite a bit yesterday too, right? So we had it's been a good week, all things considered, for spreading out the money. This morning, Milai, Amazon, but this isn't going to get it done, right? Chips alone can't get it done today. We're going to need something else. And we still got data in 15 minutes. Data that we've been waiting for all week, by the way. That move in finance or in banks yesterday, for a little while there, it was banks up, Mag 7 down. And then we got both of them working together and we had a really great day yesterday, right? So now we got to wonder, you know, is there anything left in finance today? We're going to give one back, hold one versus the other. If we can get both again today, we can continue this drive to the upside. But if we don't have finance and we only have the Mag 7, yeah, they can do the work on their own. We just got to continue to look for what's going to be pushing in the other direction, right? What's going to go against us? Are we going to lose any of the market participants that we've already got? And or what's the 0-day play? US 30, JP 30 is starting to back off of that high. The buy right ain't open yet. It's not going to function until 9:30. The US 30, JP 30, usually they're insane. We had a bit of a dis there. 4.25 in the 10-year. It's getting a bit too low. We're going to be looking for mean reversion on this, right? It's supposed to stay like in a collar in a range, not too high, not too low, a little bit of Goldilocks scenario. And if it begins to expand beyond that range, or I don't really want to say the word, but I need to, beyond that collar that exists here, then it gets hammered back into place, right? Kind of like an old school arbitrage situation. Price gets out of line, it just gets hammered back into place. So keep your eye on the 10-year because it's getting too low. So if you're long bonds, be careful long bonds. And we've still got that divergence in the Mag 7 play. This thing is setting higher highs, but you can see we're getting lower lows down here. You do not want a rally day based on nat gas, pot stocks, and uranium. Now, the administration this morning, I pointed out, had some comments about AI and the nuclear space. So we knew that was going to get a little bit of a bump into the SMRs and the nuclear reactors and data centers and AI. So we want more out of the chips, the Mag 7. I'd like to see finance getting into the game. I don't want to see it get left behind because if we start to get divergent in our 3 risk on sectors, it's going to be a more difficult Friday to play. So keep your eye on the clock today, guys, and just play what we've got level by level. Ignore those talking heads that keep talking about how bad it is out there and how we're going to, crash and burn at any moment. I'm not saying go long here, right? We've already had a whole week where we've just been running and running and running. I don't tend to buy at the highs, but I'm not calling for a short here either. If you're already in it, just stay in it. And if you're not in it, you don't really have a signal to do the opposite. So if things start to unravel, we'll play it level by level all the way back down. Otherwise, just continue to measure the next level higher, like I teach in my channel all the time. As long as we're continuing to move in a single direction, you can continue to level out the next target higher, and the next one higher, and the next one higher, and the next one higher. Do it all the time. Okay. That's what I got for you guys. Be careful, be safe, keep your eye on the clock. I'll see y'all next week.